Welcome to the very first lesson on Principles of Accounts. And this first lesson, lesson 1.1, is on accounting elements. Now, this serves as the very fundamental that you need to know in POA. So let's go ahead without further ado and start the lesson. What are accounting elements? So, in short, I would say that accounting elements are basically broad categories that group accounts together. So, this kind of accounting elements is actually different from what you typically know in the periodic table. Now, there are about 118 chemical elements there, but they are not groups per se. But in accounting, we call them elements as we use the elements to group the various accounts that you can have in accounting. We will go into the accounts much later, but for now, I need you to understand that there are 5 elements that you need to know. So these 5 elements will serve as the broad categories. And what are the 5 elements? Usually, typically, you will hear people saying ILE or any other types of acronyms, but the easiest one I find is actually ILE. That's what I mentioned. So ILE is made up of A, I, L, E, Q, as well as EX. So if you look at the first alphabet of each row here, you have A, I, L, E, and E. To differentiate the two E's, we will do EQ first and then EX. So we do it alphabetically. Then what do they each stand for? A stands for this element called asset. Okay. I stands for this element called income. L stands for this element called liabilities. EQ stands for this element called equity. EX stands for this element called expense. All right. So this is the acronym ILE, and these are the full names of each element. So how do they come into play? How do they interact with one another? So let's suppose we have got a physical shop. So you have a shop with a roof and a building, and it seems like the building itself, the bricks and all the cement, requires $2,000 to make, and the roof requires $1,000 to make. These are just random numbers that I pick out, okay? They do not represent any of this in real life. Now, what happens is this business needs to run, right? But before you can do so, it needs people to invest money in it. So where did the money come from? It can come to 2 very main sources. So supposedly we've got this Mr. R who is keen to invest in this business. And he is a little cash rich who has $2,000. So what he does is he invests this $2,000 into the business. And now this business is missing a roof, the $1,000 roof. So after sourcing out, nobody else is willing to invest, but it manages to get a loan, a financial institution, to lend a little bit of money to cover up that $1,000 that it's missing. So banks are kind of different from investors, right? From people. Banks are basically corporations or institutions that in real life basically loans money out and um, yeah, earn interest from it. So you have to return back with the interest. But for simplicity's sake, for now, bank just loans the $1,000 to the business. So obviously, um, once the business manages to get back $1,000, it has to return that $1,000 to the bank. Okay, let's just ignore the interest component for now. And also, if the business, or rather the owner decides to takes out take out the money that he invested, he can do so. He has the right to do so. He can take out his $2,000 as well. But these are basically two different sources of money. One is a loan, right? Whereas this one from Mr. R, we typically call it like an investment. So now what happens is, because there are these two different sources of money, we will classify Mr. R's money as equity. So this is the element, one of the elements that we mentioned about earlier. Whereas the loan that we got from the bank, we classify it differently and we classify it under liability. Now what happens here is the business has got that $1,000 and $2,000. So that $1,000 and $2,000, which comes in the form of cash, of course the business is supposed to go and use that money to make the shop, or it could have used it for something else. Whatever it is, this money that it has now is then classified as assets. It's a resource that it can use to make the shop. So this is how the three elements come into play. Now what about, we're missing the I as well as the EX. So as the business runs, right after setting up, and it runs for some time, 1 or 2 years, and it happens to make some profit. So as an investor, right, surely he invests for the purpose of earning some profits, some sweet bearing fruits out of the shop, of this business. So let's say the business earns some profit of $500. So this profit will then have to go to Mr. R, not to the bank, because bank typically earns the interest component, not the profit. So profit goes to the Mr. R because he's the person who invests the money into the business. And how is profit calculated? It's basically made up of income minus your expenses. So when your income is more than the expenses, then you have a profit. And that's where Mr. R, the investor, gets to keep. So these are the 5 elements that we talked about just now earlier and how they come into play. But of course, in POA, you need to remember and understand that it's not just calculation-wise. You also need to be very good at the definitions. So what are the official definitions of each element? So assets basically refers to resources that a business owns or controls that are expected to provide future benefits. So that's the $3,000 that the business gets to keep and use. Liabilities are basically obligations owed by a business to others that are expected to be settled in the future. So that $1,000 from the bank, the business needs to pay back when time is up. Equity is claimed by the owners or owner on the net assets of the business. So if Mr. R wants to claim it back, that $2,000, he gets to claim it back. And on top of that, when there is profit, right, of that $500, he too has the right to claim it. Income are basically amounts earned from the activities of a business, whereas expenses are costs incurred to earn income in the same accounting period. So simply put, you can earn, let's say this business is a bakery and it sells cakes. Now cakes, the sales that you get from selling the cakes is the income. But bear in mind, to sell the cake, you need to hire a salesperson, a sales girl. So that sales goal's the salary for that sales goal will be the expense. And if you sell a cake for $50 and her salary is $10, the difference of $40 will be the profit for one cake. So that's how the 5 elements come into play. Now just bear in mind, just to go a little further, there are 2 out of the 5 elements that can be broken down into further classification. So for assets and liabilities, you can classify them further into non-current assets and current assets, non-current liabilities and current liabilities. What does it mean for now? Just for you to understand is that non-current assets are basically resources that last beyond one financial year. So after one financial year. So one financial year is 12 months, right? So you get to keep that asset for more than 12 months. Whereas current assets are basically assets that you get to keep, or rather that you have to use within one financial year. And likewise, liabilities are basically obligations that you need to pay after one financial year, after 12 months. Whereas for current liabilities, you need to pay them within 12 months. So that's it for now for the elements. And let's look forward to the next lesson on the accounting equation.